Today, let's ask the question, what is a yield curve? The yield curve is a fundamental concept in finance, serving as a valuable indicator of economic conditions and market expectations. Shaped by the relationship between interest rates and the maturity of debt securities issued by the government, the yield curve provides insights into investor sentiment, economic growth expectations, and potential shifts in monetary policy. In its simplest form, the yield curve is a graphical representation of interest rates for a range of maturities on a particular type of debt. Traditionally, it depicts the yields of government bonds, specifically comparing short-term and long-term rates. The curve typically has an upward slope indicating the longer-term bonds carry higher interest rates than shorter-term ones. This normal yield curve reflects the time value of money and the compensation investors require for holding longer-term investments. A yield curve can take different shapes, each conveying distinct messages about the state of the economy. A steep upward sloping curve often signals expectations of robust economic growth, as investors demand higher compensation for tying up their money in longer-term investments. Conversely, a flat or inverted yield curve, where shorter-term rates are comparable to or higher than long-term rates, can be a harbinger of economic challenges, potentially signaling an economic slowdown or a recession. Central banks closely monitor the yield curves as part of their economic analysis. Changes in the yield curve can influence monetary policy decisions. For instance, an inverted yield curve might prompt a central bank to consider lowering short-term interest rates to stimulate economic activity. Investors also scrutinize the yield curve for its predictive power. An inverted yield curve has historically preceded economic recessions, making it a notable signal for market participants. However, it's essential to approach yield curve analysis with nuance, considering various factors that can influence interest rates, including inflation expectations and global economic conditions. In conclusion, the yield curve is a versatile tool that provides a snapshot of interest rate dynamics, economic expectations, and potential shifts in the financial landscape. Understanding the messages conveyed by different shapes of the yield curve equips investors, policymakers, and analysts with valuable insights to navigate the complexities of the financial markets. Please note, while we may discuss finance, investing, and money on this channel, this video should not be considered financial advice. When investing or making plans for your own financial security, please seek the guidance of a licensed professional capable of making more informed decisions. If you make a financial life decision based upon the content of this video or channel, then please do so at your own volition and at your own risk. This channel and the people associated with it should not be held liable for your investment choices.